Welcome to VIX Guides, building resilient financial models in uncertain markets. In today's dynamic and volatile market landscape, shaped by geopolitical tensions, inflationary pressures, and rapid technological shifts, financial models must evolve beyond static spreadsheets. Having a good framework in place is essential for any investor hoping to quantify risks, adapt to shifting economic indicators, and maintain decision-making agility. With 9+ years advising Fortune 500 firms and SMEs across banking, healthcare, and technology sectors, this presentation distills actionable strategies for creating adaptive models that withstand black swan events while preserving stakeholder confidence. Navigating volatility. Traditional models falter under extreme GDP fluctuations, geopolitical disruptions, or rapid interest rate changes. Resilient models incorporate probabilistic forecasting and adaptive variables, enabling firms to simulate risks like supply chain breakdowns or regulatory shifts. This reduces exposure to black swan events by 25 to 40% in stress-tested scenarios. Maintaining confidence. Transparent risk simulations and sensitivity-adjusted projections foster stakeholder trust. By quantifying downside risks, e.g., liquidity shortfalls during market corrections, models align leadership teams on mitigation strategies while meeting compliance requirements like Basel III or IFRS 9. Explore possibilities. Scenario planning evaluates outcomes, ranging from baseline to extreme scenarios, e.g., commodity price collapses, cyber attacks. Monte Carlo simulations and probabilistic modeling assign likelihoods to each scenario, enabling resource allocation based on risk-adjusted ROIC. Prepare for uncertainty. Multi-scenario frameworks embed contingency triggers, such as automatic debt covenant renegotiations or inventory buffer adjustments. This reduces contingency planning lag from weeks to days during disruptions. Identify critical factors. Tornado charts and one-way analyses isolate variables, e.g., customer churn, FX rates, driving plus or minus 70% of forecast variance. Automated dashboards flag deviations beyond preset thresholds for executive review. Quantify impact. Regression analysis measures how plus or minus 10% input changes alter outputs like NPV or IRR. This prioritizes risk mitigation for high-sensitivity variables, optimizing hedging spend by 18 to 22%. Models simulate 3 standard deviation events: hyperinflation, systemic cyber failures, or 30% equity drawdowns to test capital adequacy. Reverse stress tests identify failure thresholds, e.g., minimum liquidity ratios. Post-stress diagnostics reveal hidden correlations, such as supply chain bottlenecks amplifying working capital gaps. Recalibrating inventory turnover assumptions improves cash flow predictability by 12 to 15%. Boundary testing, e.g., zero revenue scenarios, exposes flawed debt service coverage ratios. Modular model architecture allows rapid assumption swaps without full rebuilds. Traditional models often rely on static assumptions, which can be problematic in rapidly changing markets. Incorporating dynamic forecasting techniques allows models to adapt to evolving conditions and generate more accurate projections. Scenario-based modeling allows for the exploration of multiple potential outcomes, accounting for different market conditions and uncertainties. This enhances model adaptability and helps businesses navigate through volatility. Data analytics allows for the identification of early warning signals, such as shifts in market sentiment or changes in economic indicators. This proactive approach provides valuable insights for timely risk mitigation. Data-driven insights from analytics help refine model assumptions and improve the accuracy of financial projections. This continuous feedback loop ensures the model remains relevant and responsive to market changes. Automating model updates with real-time data ensures that the model's projections are accurate and up-to-date. This dynamic approach eliminates the need for manual adjustments, saving time and reducing the risk of outdated information. Automated model updates enable timely responses to market changes. This empowers businesses to make informed decisions based on the latest data, enhancing agility and responsiveness in a volatile environment. Communicating the model's limitations and assumptions to stakeholders ensures transparency and builds trust. This helps them understand the model's scope and potential limitations, enabling informed decision-making. Open communication about the model's underlying assumptions and limitations fosters a shared understanding among stakeholders. This strengthens alignment and promotes confidence in the model's outputs. Minus ... From volatility to value creation, transform uncertainty into strategic advantage.